4.5% 30-year fixed. We have auto loans climbing, mounting interest rates on variable credit cards. So are these rising rates enough to throw a chill into this bull market run that we've had? Let's ask our traders. Teddy, what do you think?
I think if you predict the negative side of this equation long enough, eventually you will be right. There's no question interest rates are going higher. The Fed has done an excellent job at basically dealing with expectations and handling the higher interest rates. But there is another side to this argument, Liz. There are also people telling us that interest rates are not going higher because we don't know the full effects of all this tariff stuff, and that could put a blanket on not only the U.S. economy but the world's economies. But in terms of the U.S. economy, I think it's fair to assume they're going higher. The big question is how high and how fast. I don't think we're anywhere close to the tipping point yet.
Okay. Scott Bauer, do you agree with Teddy, or do you feel that when it costs more to borrow money, that, let's not say chill, let's say it flips on the air conditioning switch a little bit on companies that are considering borrowing money to grow? And if so, where would you expect to see, which sectors would you expect to see slow down after what has been a great bull run?
Well, first off, I do agree with Teddy, and I think we're nowhere near the tipping point. That being said, I do think it is, the caution flag, maybe proceed with caution, the yellow light. But at this point, Liz, we're seeing wage growth still outpace inflation by a little bit, or at least keep up with it. So I don't think that it's really hurting people in their pocketbooks yet. And if you're concerned about the overall market picture and how it may affect the market if there's going to be a downturn, with volatility the way it is, the way that it has come in, we're at a point where you can buy such cheap protection. Now, in terms of which sectors might that affect the most, well, I would certainly look for tech. Some of the big tech that is still borrowing cheap money, that may come off. They may not be able to do that any longer. So I would definitely look for that. But I don't see anything happening in the near term or even projecting out 6 to 12 months where interest rates are really going to take over and spook the marketplace where the next couple years is all based on higher interest rates. I just don't see it.
Phil, this economy is not in a hospital bed anymore. It's no longer even standing and lurching around the hallways in a hospital gown holding on to the IV. It is doing very well, and that's a good thing. Don't we have to grow up? And Jay Powell has said, we're going to continue rates. President Trump doesn't like it so much, but where do you see the effects?
Yeah, I agree. It's a sign that the economy's getting better. I mean, listen, Liz, when you look at the history of interest rates, we're coming off a 3,000-year low in interest rates, right? We never had interest rates this low before.
Right.
And yes, a 5% interest rate is getting back to a more normal. But it may hurt some businesses. There's no doubt about it. In the shale patch right now, they've been in debt up to their eyeballs. They're finally getting prices to go up a little bit. They're going to have problems, having to borrow at a higher rate. But there is some arguments that are saying that, that this 5% interest rate that Jamie Dimon is talking about may be way too high. There's a lot of analysts that say we're going to come up against a major trend line with interest rates, that we're going to see the short-term rates not get much above 3%. So he may be waiting a long time for that 5%.
I would think so.
We'll have to wait and see.
10-year yield is at 2.97%. We got a ways to go before we crash through that ceiling of 5%. Teddy, Scott, Phil, love your perspective. Thank you.